Hello all of you knowledge seekers, and welcome back to Knowledge with Alar. Let's get to the first book in my series, Modern Value Investing by Sven Carlin. Chapter 2, Value and Behavioral Finance. In this channel, I give you knowledge with a lot less time than it would take for you to read these books. If you really want to gain knowledge, buy these books. You can get them from Amazon. I can add a link down below. One thing is to read a summary, and the other thing is to really study the material. I urge you to study these books alongside with me. I'm just here to basically to give you a very thorough review. And let's go and continue with the book. So chapter 2, Value and Behavioral Finance. Quote, "The most important quality for an investor is temperament, not intellect." Warren Buffett. The efficient market hypothesis and the issue with passive investment vehicle. A nice saying by Charlie Munger about the efficient market today. Quote, "I have a name for people who went to extreme efficient market theory, which is bonkers. It was an intellectually consistent theory that enabled them to do pretty mathematics. So I understand its seductiveness to people with large mathematical gifts. I just had a difficulty in that fundamental assumption that did not tie properly to reality. Efficient market theory believes that low risks lead to low earnings, and if you want to have high earnings, you have to risk more, so the risk would have to be higher. The first to officially write about that was a Nobel Prize winning economist, Harry Markowitz, in 1952. He's now called the father of modern portfolio theory. The theory was followed by another Nobel Prize winner called Eugene Fama in the 70s. He wrote an article in the Journal of Finance entitled Efficient Capital Markets, a review of theory and empirical work. It laid the basis for the mindless investing that has been going on for almost 50 years now. The theory states that the price of a security is always right, as the market quickly prices in all new information. Therefore, there is no point in doing fundamental analysis. There is no point in picking stocks. You should just pick any stock on the market, let's say S&P 500, and just blindly buy that at any given time without doing any research, because the efficient market theory states that the market is always rational, and the market is always priced rightly. If something changes, then the price rises. If something changes for the worse, the price goes accordingly. From this picture, you can see the modern portfolio theory on a graph. So if the risks are low, earnings are low. If the risks are high, the earnings are high. Value investing beats growth investing. Quote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Benjamin Graham. It is almost funny that the same Nobel Prize winning economist, Fama, who was the face of efficient market craze in the 70s, has evolved over time and has now stated that value investing beats growth investing in the long run. The two market anomalies that show how markets aren't efficient after all are size and value. Fama explains the overperformance through additional risk, but We will see in upcoming chapters how value investors approach risk differently than academia. So for us, the risk is marginal. The work was published in 1993 by Fama and French, and it was published in the Journal of Financial Economics. The article was called Common Risk Factors in the Returns on Stocks and Bonds. Scientifically proven, value investing is always the way to go. The extremely valuable data provided by Fama and French in 1993 is available online. The author of this book, Sven Carlin, has used this data to compare growth investing and value investing. He's taken data from 1927 up until now and taken 10 years. So every year you start and you invest for 10 years in growth stocks and in value stocks. The value portfolio is created by putting into it all traded stocks in the lowest 30% of price to book value, while the growth portfolio is created by the 30 highest price to book value stocks. Usually growth stocks have the highest price to book value, so that is why the research was done like this. That should show a pretty accurate difference between value stocks and growth stocks. And the results are incredible. From this picture you can see that value investing has beaten growth investing by 4.6% in the average since 1926. In only 6 times over these past 90 years has growth investing beaten value investing. But to give you a better idea, I will draw an example for you. Let's say you invested 100,000 euros for 10 years. The average growth portfolio rose 5.7% in the average, and the average value investment rose 10.3%. The growth portfolio would grow from 100,000 to 174,000 euros in 10 years. Now comes the big part. The value investment portfolio with 10.3% return would grow to 266,000 euros. The difference is 92,000 euros. That's almost 100% of the original return. As you can see, the difference is huge. If people know this, then why isn't everyone a value investor? Well, the answer is pretty simple. It is in human nature that people tend to look for shortcuts. They want to have excitement. They want to have big gains in a short time. They want to do what everyone else is doing. Value investing is boring. You really have to be patient. You really have to think about things if you want to be a value investor. Usually only boring companies have good price to book values. Also, the problem is that growth stocks work fine if the market is good, In a bull market, growth stocks do really, really good. But as soon as there is a recession, the growth stops. Many companies now are in danger of going bankrupt because the capital injections stop. But value investments can always rely on assets owned, and these companies can weather the economic cycle. Over the long term, value lowers risk, and that is what value investment is all about. It is important to minimize losses, not seek gains. How to improve value investing? Fama and French only used price to book value on their research. Sven Carlin says that if we would also take different sectors into consideration and avoid sectors that are definitely going to fall in the future, the results would be even better. The author says that you have to really use common sense in investing. Buy tangible values that will be valuable no matter what the economy does. If you believe the last 100 years worth of data and not jump on the hype train whenever it comes, then you are a value investor. Value investing is the best strategy for both professional and part-time investors. The value investing approach is hard because you have to think independently. You cannot blindly follow the herd. You have to think for yourself. Every step you take, every investment you make has to be made rationally. It requires patience. If you don't find a company that satisfies all your criteria, then you simply don't buy. You keep on looking, keep on waiting. And one really important thing you have to keep in mind is that this strategy will most likely be out of favor from the mainstream investing community. People might call you an idiot. People might really try to push their ideas onto you. Quote, individual and institutional investors alike frequently demonstrate an inability to make long-term investment decisions based on business fundamentals. Sven Carlin. Growth investing is exciting, and that attracts the majority of investors on promises of quick riches. That is bad for most investors, but it is good for value investors, as it creates market inefficiency and allows the value investor to take advantage of that. If all investors would be value investors, it would be impossible to find bargains on the market. During a bull market, it is often said that value investing is dead, and it is a very popular thing to say in this year, in 2019. The market has been growing for 10 years, so everyone is so pumped up, they're gaining so much money, and everyone has forgot that the economy is cyclical. It's never going to be like this forever. In 2019, everyone is investing in index funds and big tech companies because they just follow the fads and they believe the market is going to rise forever. This was also the case in the 90s when everyone was chasing the dot-com companies. Everyone wanted to get rich quick. In every decade there is a new fad, another big hype train that everyone wants to get on. And that is just human nature. Here is a nice quote by Sven Carlin. A rising tide lifts all boats, but all those hot strategies fade when the tide shifts. You have to be prepared that in the bull market, other people may do a lot better than value investors. Your local taxi driver may have better returns, but if you're a value investor, you have to have a long-term orientation. In the long run, you're going to beat the market. Relative and absolute performance. Most investors have adopted a relative performance orientation. They have to beat the market. That is their main goal. They have to beat the market. Is the stock market up or down? That doesn't really bother them. Of course it bothers them, but if they beat the market, then they're already happy. That is just how it is. But value investors take absolute performance into their main focus, and they don't care where the market is at any given time. The important thing to a value investor is how their investment returns and risks correlate with their investment goals. The biggest problem with relative performance is that people follow the market and just make small adjustments around it. So when the market goes down, they go down because they are basically the market. They're doing the same thing, all the index funding, and they're buying everything that is up. So when a crash comes, they go down alongside with it. And the worst thing is that in Wall Street, every fund manager is doing the same thing. If a fund manager says to their clients that in this year we're doing worse than the S&P or whatever, the market, then the fund manager is going to lose clients, and when the fund manager loses clients, he loses his job. So in the Wall Street, everyone is doing the same thing because it is good, it is better for their career to do exactly as everyone else is doing and just beat the market. Now the biggest problem with this mindset is that the crash always comes. If you look at historical data, every 7 years there is a crash. At the moment we have been going up 10 years in a row, so we're already past the historical average. When people finally understand that they have been chasing a ghost, the house of cards always collapses. But if you hold a well-diversified portfolio, where every investment has a margin of safety, you are going to beat the market in the long run. Just don't look at the market so often. Nobody cares what is going on, if it's up or down. You might be behind during the bull market, but who cares? Slow and steady wins the race. The most important thing to avoid is losses. From this picture, you can see an example. If you invest 100,000 euros over the next 20 years and you have 4% returns per year, you are going to have 210,000 euros at the end of these 20 years. But if you invest 100,000 euros and in 4 years' time the market crashes 50%, and then after that the market starts to rise at now 8% return in a year. If you lose 50% and then after that you gain twice as much as before, you're still not going to recover. In this example, after the 20 years you're going to have 178,000 euros. That is more than 30,000 euros less than before. But as we said, the average cycle is 7 years. So let's look at another example where on the 13th year the market crashes another 25%, and after that starts rising 8% again. After 20 years you're going to end up with 123,000 euros. This example is so important. This is the reason why value investing beats the market in the long run. The most important thing is to minimize losses, not seek gains. During a bull market, people never believe that something bad is going to happen, but it always does. The recession always comes. Economy is cyclical. It always has been and it always will be. What helps us to better understand ourselves and our investment decisions, that is going to come in the next chapter. That is called behavioral finance. So thank you guys so much for watching. I hope you loved this video. I hope you liked this book. Really terrific book. I really recommend you to check this book out. I will add my affiliate link down below, so if you want you can buy it on Amazon. I really recommend getting a hard copy. It's just nothing beats having a proper book in your hand where you can take notes and you get that new book smell, which is kind of awesome. And also I really recommend you checking out Sven Carlin. I will add his YouTube channel down below. He's a really smart guy. Also check out his research platform. He does business research full time, and he has built a research platform where he gives that information to his customers. Really priceless stuff, and you can get great investment knowledge out there, and maybe even a couple of investment ideas. But keep in mind, every investment hint you get somewhere, do the research yourself. This is what this book is all about. Gaining the knowledge how to do the research yourself. Because if something goes bad, you only have yourself to blame. You can't blame someone else for your mistakes. But thank you guys so much for watching. Please give me a thumbs up. That will really help me on this journey. If you like this video, please leave a comment and subscribe to my channel for more weekly content. See you guys.